This is A K Asnani from Smart VERC. Topic of the module is how to sell a loss-making stock. Consider a stock of the company XYZ, hypothetical company, and investor spotted a great opportunity when the share price was rupees 236. So he thought this could be a good price to buy the stock, but as usual, a retail investor waits for some action in the stock, and he did the same thing. Unfortunately, stock went up, and it went up pretty fast, and he wasn't able to buy the stock, and then it reacted a bit, and then again it started moving up, and then in the second reaction he thought this could be the best price to enter into the stock. So he purchased the stock. Of course, he could not buy at rupees 236, but he could get it around 280 levels. And he was very fortunate. After buying the stock bounced up pretty fast, and it gained handsomely, and it continues to gain, and he is happy that though he entered late, but he made the right decision. Oh, unfortunately, the stock came down and came down heavily, but still the share price was above his buying price, though marginally, and then again it bounced back. Now the share price after was unable to pierce its recent high, and it reacted heavily, and so much so that it almost touched his buying price, and now he is very cautious because he doesn't want to make a loss. And the stock moved up once again pretty fast, and after making some reaction it again moved up and made a new high, and now he is 100% confident that he made the very correct decision. And this all is a part of volatility, and it happens in every stock, and that is his views. And stock is trying to break its previous high, but suddenly falls down, and nothing to worry because stock price is still higher than its buying price. But what this happened? Corporate governance issue. Wow, that is very unfortunate. Though strong negative news about the company has been made public, still you do not want to sell. Why? The reason is very simple. He does not want to book loss, and he is very confident that stock price will bounce back, and the reason is not known, but he has his internal confidence that stock will bounce back. But it did happen, but not to that extent, and it reacted once again, and now the stock is substantially down from his buying price to the current price of about rupees 150. If he sells the stock, then he will have to make a loss of about 45%, and it is a big loss for him, and he says that he is not prepared to book so much of loss, and why not to buy more and reduce the acquisition cost. In the past also it has happened that stock bounced back, and it has happened multiple times. So he buys one more lot, and his logic is the stock is down by about 60% from the last high and it is a good bargain. Now his average price is rupees 215. Previously he purchased at 280 and now at around 150 rupees. So the average buying price is 215. Still it is higher than the ruling price but much lower than the first price. But something very unfortunate happened and the stock continued its downward journey, and that too very steep. Now the current price is about rupees 60 and is way lower than the average acquisition price of rupees 215. So he says, unless I buy at this price, I am not going to recover my money back. Yes, very natural, because he has purchased at 215. So his logic is of course correct. He cannot recover his loss so easily, but he should also try to understand that the company has come under the corporate governance issue. Company has accepted themselves. Yes, there is an issue, and but investor is not willing to book loss, and now the change of mindset has happened. Earlier the objective was to earn money and now the objective is to recover the investment. So he buys once again and now the average buying price is rupees 163. But unfortunately the share price went down to about 25 rupee level, 25 to 30 rupee levels. So in a nutshell, his first buying price was 280 rupees, second 150, third 60, and now the present price is 30, while the average buying price is 163. Way down from the average buying price and heavy losses. What was the reason? Every time he anchored to the first buying price. He anchored to the average buying price. He made them as the reference marks. And there is nothing new. This kind of story is applicable to most retail investors, and again. See, now I will show you some of the cases from March 16 to December 19. This is on quarterly basis. This is the retail investor stake in percentage term. In PC Jeweler, retail investor stake increased from 5.36% to 38.65. This is more than 7 times, and the share price from 177 to 12 rupees. This is a change of 98%. Negative change. That means and this negative change is with respect to the high price. During this period, stock made a high of 587. So those who purchased at 587 are at a loss of 98% on their investment. Yes Bank 8.89 and 47.96. This is again something about more than 5 times increase in retail stake, and the share price is down by 92%. Arcom, there is wonderful. Investors are so much, retail investor is so much confident that he has increased his stake by more than 7 times from 8.92% to 71.66%, and the loss is also the highest. So more the increase in stake, the more the loss. R Power, similar kind of story. Jet Airways, similar kind of stories, and during the same period Nifty 50 was down by only 27%. Now you can see the percentage change in these stocks from their historic high and compare with Nifty 50. And there are more examples. Diwan Housing Finance Limited 98% fall, 95% in Vakranji, Auto Circuit 80% fall, 8K miles 97%, 1% beverages from 1.56% stake to 26.49% stake. Oh, this is about 15 times, more than 15 times increase in stake, and the share price is down by more than 99%. Quality Limited, almost similar story with 99% fall and increase in stake by about 3 times, 3.5 times. They keep repeating this type of story and never learn from their mistakes. In fact, financial institutions and retail investors often move in opposite direction. In case of the stories what I have shown you, these were the stories of falling stocks, and in these stocks financial institutions were exiting and retail investors were entering. And in case of the multi-bagger stocks, it is the reverse. When the companies are small or medium size, there is a lot of retail investor participation, but as the company grows bigger in size, as the company's profits grow, retail investors start exiting while the financial institutions start entering. They always move in most of the time they move in opposite direction. So what went wrong with the retail investors? Why they are doing like this? Because most of the time their decisions are anchored to the buy price and the current price. They are always thinking in terms of the price. As I have shown you in the chart, every time retail investor is getting tied up with the past price, getting tied up with his buying price, getting tied up with the current price. But the winning formula is always get anchored to the intrinsic price. What is the real worth of the stock? That matters. Ultimately, that matters. You have to compare the real worth of the stock with that of the current price, and then and only then you can really make profits. Otherwise, you are working in dark. You are playing in dark. Now, how to sell the loss-making stock? Basically, it is not that every investor always make the gains and he never makes any losses. It is not like that. And every investor makes a loss and he need to exit from the poor stories, right? So what is the way how to overcome the emotion of bearing a loss? Sell the stock with negative story and buy another with positive story for the same total amount. So basically you are switching from negative story to positive story. When you are switching like this, then you are literally mitigating the market risk in the immediate term. So whether the market goes up or down, both the stocks will move in the same direction and there is hardly any risk. And when you are buying a stock with more positive story, you are trying to create alpha. Yes, you are trying to outperform the market. Averaging should be done only in stocks with positive stories. Yes, not with negative stories. Always avoid averaging in negative stories. Instead of averaging, investors should sell the stock with negative stories. Yes, had he purchased a positive story stock, I am very sure he must have recovered his losses very soon. Averaging should be contemplated only if the stock price is at least 25% below your last buying price. Yeah, I have observed that often investors add more and more stocks at small variations. If I ask an investor to buy a share at rupees 1000 and if it falls to 975, he again buys it. No, don't do that. Else soon you will be out of funds, out of cash. So make it a thumb rule that you will buy again only if the stock is down by say 20% or 25% below your last buying price. And this has worked for me from last so many years. Okay, do you know why more than half of the mutual funds and more than 98% investors are not able to outperform the benchmark index? Because indices keep replacing the stocks. You must have observed. Almost all the stocks in Sensex are leaders in their sectors. So outperforming a bunch of stocks which are leaders in their sectors is really very, very difficult. Beating such stock combination constantly by wide margins and for several years is really a very challenging task. But if you want to do that, then this is the right thing to do. You have to exit from the negative stories and enter into the more positive stories. SBP stands for Smart Billionaire Picks, and this was the basket of stocks which was started way back on 31st of May 2001. And as you can see, out of the 18 years, in 13 years, SBP has outperformed the Sensex, and that is the secret of success. As I told you, always keep investing, keep averaging in positive stories. This is the principle of averaging as I was referring to. If the intrinsic worth is say rupees 100 and stock is available at rupees 75, then buy it. There is a reasonably good safety margin, and second buy should be around rupees 55-56 when the stock is down by about 25%, and the third buy should be not before rupees 42. But here I would like to caution you, if your stock has fallen more than 45 or 50%, that means there is something wrong in your pick. There is something wrong in your calculations, and be very careful, be very, very confident for averaging your stock when the stock is down by 50% or more. And still, if you are not able to sell the loss-making stock, then there is very simple thumb rule which I apply and which I advise to all the investors. Ask yourself, had I not owned this stock, would I buy today at the current price? If the honest answer is no, then sell that stock immediately. This works wonderfully well every time. A single bad stock can destroy your portfolio returns much more severely than a multi-bagger stock can get you those kinds of returns. Imagine a stock ruling at rupees 100. If it falls down, say by 90% to rupees 10, then it has to increase by 9 times. So you need a multi-bagger which increases 9 times to recover your loss in that single stock. That is very, very difficult. It takes long time. Not only it takes a long time, but it is really very, very difficult to find multi-baggers regularly. So be very careful with the loss-making stocks. Smart word. Stock buy price reflects the past. Intrinsic worth tells about the future, and it is the future which will drive the stock. Forget about the past price. Past is past. That has no relevance with the future prospects now. So look at the current price and look at the future prospects. If it is justified, then you buy or average. We have a scheme with the name of Dr. Smart, in which we ask only for the quantity and the name of the shares in your portfolio, but we don't ask for your buy price. Often the subscribers of such services, they ask, then how you are going to decide? It's very simple. What we are going to decide is the intrinsic worth of the stock. What we are going to decide is on the basis of the future prospects of the stock, not on your buy price. Thank you.